So once again, good evening, everyone. My name is Yogesh. Thank you so much for your patience. We'll start this session now, and we are going to talk about today understanding strategies for volatile markets. Before we begin, I want to make sure that everybody can hear me properly, so you can use your chat options to answer me. If you can see my content, if you can hear me properly, give me a yes or a okay. Can type on your chat options, which you can later on use as well, to ask any questions if you need. Give me a yes or okay if you can hear me. Okay, perfect. Great. Thank you so much. Thank you so much. It's really important for me to check this. So just in case, guys, if there is any issue in the network, or if you feel any congestion in your network, or if you have to leave all of a sudden, we keep uploading the recordings of these sessions also on our website. And you can talk to your relationship managers, and they will guide you towards where to see the recording, right? We'll talk about a lot of strategies today, and please understand this. The one strategies which I'm talking about are based on historical pricing, on a lot of market sentiments. And while we were making these strategies, the sentiments and the pricing, everything is subjected to change over a period of time. And that's why whatever I'm going to discuss, understand the concept of it, but do not just apply blindly to the same thing to your portfolios. Talk to your risk consultants, understand the risk properly, because all these strategies, they have a certain degree of risk also, and you have to talk to your risk experts, you have to talk to your financial consultants, check your risk tolerance, and only then apply those strategies once you feel that you are able to take that chance. um, we are going to talk today about trading strategies. We are going to talk about market neutral investing, seasonality patterns. So this is something which I do every month, but these kind of strategies, they change every month. Like for example, seasonality. I don't know how many of you have attended these sessions before. Last month we had a seasonality pattern on natural gas, and that was for seasonality in August. Then now it is September, so seasonality is different. But I'll tell you, if you had done that trade, the returns would have been higher in terms of if you have conducted this seasonality strategy a month ago. So every month I do these sessions, and the very concept of the strategy remains the same, but the instruments, they are different. Like last month it was natural gas, this time it could be sugar, or it could be oil, or it could be any of these instruments, right? So today we are going to talk about market neutral strategy, we are going to talk about pair trades, going to talk about seasonality analysis, we are going to talk about interest earning ideas in terms of we'll put South Africa and Nasdaq into picture. And some strategies has been going well along in last few months, so we are definitely going to keep them. Some of them have changed, so we are going to replace them with the new ones. Now, what market neutral investing is, in the current timings, we have seen a lot of market movements happening in terms of, if you see cryptocurrencies itself. Can anyone tell me, and using your chat options, what was the average decline in the crypto market yesterday? On an average, cryptocurrencies went down. I'll be using the live trading platform as well to show you the live price movement in a lot of asset classes. So just tell me if you are following the market. You can Google it also, by the way. Yesterday, an average decline in the crypto market. How much was an average decline in a crypto market? I saw Bitcoin prices going down, Cardano going down, and it was a very sharp decline. Let me show you here. Let's make it more and more interactive. I'll bring the live platform as well. Let me show you. This is Bitcoin right here. And I'm just taking yesterday's. Let me show you here. Look at this. Look at this right here. This is the fall from 51,000 all the way. Look at here. This was a drop. This was big drop. Right. Let's see. For altcoins around 25%, 30%, Bitcoin 17%, 11%. Absolutely, that's amazing. Very good, guys. Those who did not search or Google or did not answer the question, uh, keep trying and keep looking for this, because what happens is when you search something on your own, it retains in your mind for a longer period of time. So all I'm trying to do is put some price anchors into your mind so you remember, because yesterday, that's correct, Bitcoin went down by almost 17 to 18%. Other altcoins also went down a lot, and they recovered. So look at this one, the chart which I'm showing it to you right now. This is the big fall which happened, and look at this. This went down. The red one is when it went down, and the green one when it went up. Within 5 minutes, look at this, 7:05, 7:10. Within 10 minutes, it went down all the way to 43,000, and then it went up to 47,000. $4,000 movement in just 5 minutes. Again, 44,000 came back to 46. So this is where it is right now. So, point I'm trying to make is the markets are really volatile. There's a lot of fluctuation which is happening, uh, from pandemics, Delta variants to interest rate decisions, inflation growing in the economy, stock earnings coming in. Uh, so many things. It contributes to the fluctuations in the market. Now, during these scenarios, an ordinary trader will think, okay, let me decide on a trend, take a trade, put a stop loss. It hits the stop loss, I'm out of the market. If it hits my take profit, I made profit and I move on. Something which is called speculation, you can do. Uh, Nothing wrong with it. As long as you're able to manage your risk, you're putting your stop losses right, you have to take this chance of whether your trade is going to be right or going to be wrong. Now, over a period of time, and when we have seen there is so much volatility, researchers have started working more focusedly on market neutral strategies. What are market neutral strategies? Market neutral strategies are the kind of strategies which gives you an edge uh, over the market price movements. It saves your portfolio. So basically, uh, the way the market moves, or sometimes when you buy something, let's say if you had bought Bitcoin yesterday, how sensitive Bitcoin could have been to your portfolio. When the crypto market fell down, Bitcoin went down by 18%. Imagine throughout the day you didn't see anything else, and by the evening for 5-10 minutes Bitcoin just drops by 20%. So much sensitivity to the market, right? So what market neutral investing is, market neutral investing basically aims at maintaining a low market risk and limit the sensitivity to the shifts in the broader market. So what happens is the market risk is reduced, but yeah, the security specific risk is high, but the reward is also accordingly. So basically the idea is, if you have bought a portfolio of stocks and left it, imagine pandemic, for example, you bought some stocks in January and you left it till March or April, you would have seen stocks going down, right? So what we understand is, if you're a passive investor or an active investor, it does not reduces your market risk. Your market risk is still prevails. But if you're a market neutral investor, then to a certain degree, it reduces your market risk. It brings it a notch lower. And again, try to build strategies around it. So the strategies which I'm going to show you today are going to be few market neutral strategies. Some of them are in the form of arbitrage, some of them are in the form of pair trading also. And talking about pair trading or statistical arbitrage, so statistical arbitrage is basically based on numbers and a lot of quant. Okay. Now, from a basic layman language, I don't want you to talk, I don't want to discuss more about standard deviation and how it is computed or anything. But I'm going to give you an example of a couple of pair trades. And before pair trades, one thing which should be very clear to all of you is, do you know about short selling? Yes, no. Okay, and there. I have issued a poll right now. Would really appreciate for all of you to answer this question, because the very basis of pair trading is dependent on taking a buy position, taking a short sell position. But you should know that what a short sell position is. So I just want to understand how many of you are aware about this. I'm going to take you through the platform and tell you how short selling works, so you understand that why I'm buying one and short selling another. That's the basis of all these strategies. Right, a lot of people informed here. That's great. Perfect. Right, I'm just going to take 10 more seconds before we finish the poll. 9, 8, 7, 6, 5, 4, 3, 2, and 1. Okay, that's great. Around 80% of the crowd aware about short selling. For the remaining 20%, let me just quickly go to the platform and show how a transaction on a live market works. So it will be easier for you to also catch up right here. Look at this. So right now, the total money which you have in your trading account is $100,000. Okay. How a short selling transaction works? Short selling involves making money from the falling prices. So the process involves you selling something to the market, expecting prices to come down so that you can buy it back at a cheaper price, right? For example, this is a bottle of water. I think today, if it is expensive, I can borrow this from a grocery store. Mind you, not buy it from a grocery store. I can borrow it from a grocery store and sell it to someone and take money. Let's say 5 dirhams, for example. I keep this 5 dirhams with me, and tomorrow, if the price of the bottle of water comes down to say 1 dirham, I go back to the market and I buy it back for 1 dirham and keep 4 dirhams in my pocket and give the bottle back to where I borrowed it from. As simple as that. You can actually borrow the instrument which you're expecting the prices of which is going to go down. You can borrow that from your broker, sell it live in the market, and if price goes down, buy it at the cheaper price, keep the price difference in your pocket, and the commodity or the instrument goes back to your broker. Right? Just to give you a live demonstration, what I'm doing right now, I'm going to short sell it. I have not taken any trade so far. I am expecting, let's say, I'm expecting that the price of Bitcoin is expected to come down. Let's say, for example, I have $100,000 and I'm expecting that Bitcoin prices might go down. So I write 1 unit, press enter, and this is sell. So while I'm pressing, that means I am borrowing Bitcoin from my broker's inventory, and I'm going to sell it for 46,000. This price, what you see right now. I click on sell and I sold Bitcoin. Now, the question which comes into your mind, how can he sell something which he doesn't have? How did I do it? I borrowed it from my broker's inventory and sold it. Now, when I sell one Bitcoin, it is worth 46,200. If Bitcoin falls down to say 45,200, what I will do, when I sold the Bitcoin, hypothetically in my mind, I get $46,200 because I sold one coin, so I get that cash. Now, when the Bitcoin is come down to 45,200, I from my 46,200, I give 45,200 and $1,000 in my profit. I bought back the coin and gave it back to the broker. So exactly how short selling works. Now, why we discussed about short selling? Because in this platform, you can buy when you think the price is going to go up, and you can short sell when you think the prices are going to go down. And you do that and create a market neutral strategy with the relatable instruments also. Now I'm going to show you a couple of strategies which works on this basis, and these are called market neutral strategies. I will start with something called gasoline and WTI, right? Just let me see. This is visible to everyone. Please, guys, feel free to ask the questions. I know it's not right to expect that everybody will understand everything at the first time. So, okay, now this is my first strategy. Let me share it. Just 1 second. Okay, maybe gasoline WD, I'll bring it. Let me show you one strategy right now. Let's start with the cryptos. Now, how every market neutral strategy or every pair trade strategy would work. The very concept about pair trading strategy is it is focused on reducing the risk, right? Once again, it is focused on reducing the risk. So when we talk about whether the strategy is going to make money or not, first and foremost, what you have to understand about every strategy is whether you will be able to reduce your risk with it. Focus on loss minimization rather than generating profit. That is the key. Question, let us say if we have only $5,000 on account, can we still, so there's a question that if we have only $5,000 on account, can we still sell 1 unit? And what about in terms of leverage? So you can still sell 1 unit of Bitcoin if you have not 1 unit. So there are ways. As of now, Bitcoin margin is 50%. So if the current price of Bitcoin is 45, or say for calculation purposes, if the Bitcoin price is $50,000, the minimum margin blocked will be 50%, which is $25,000. So you need to have $25,000 in order if you want to sell 1 Bitcoin. Okay. Another question, if you have $5,000, you cannot sell 1 unit because you need $25,000 for that at least. And that is again, at least 25,000, which will be a high leverage if you do that. Because if you have $25,000 in your account and you short sell 1 unit, so entire $25,000 goes as a margin. So you need to have more money to hold it for your losses. So if you have $5,000 on your account, I would suggest you can still buy in fractions. So not necessary that you have to have 1 unit off. You can have 0.00 some units and you can still trade. So that is possible. Another question, do we offset the short sell the same day before the market ends? So it depends on what the strategy is like. Okay. It's not necessary that by the end of the day, you're not forced to close both the legs. Let me show you the strategy and I think it will be more clearer then. Now, this is a ratio pair trade. Long Dash versus short Monero. So Dash and Monero both are cryptocurrencies. Okay. The chart which you see, now this is called a ratio trade or a ratio pair trade. Okay. What is a ratio? If I want to find ratio of anything, how do I identify ratio of anything? If I say gold silver ratio, so gold prices is $1,800, silver price is $24. So 1,800 divided by 24 will be the gold silver ratio. Anything when we talk about ratio is commodity A divided by commodity B, and you will find the ratio of it. So when I say the ratio of the trade or ratio of the pair, which means you are looking at prices of Dash, prices of Monero, divide both the prices, you will find the ratio, right? Again, guys, I'm sure some of you might already know this kind of calculation, but I'm trying to make simple for everyone. Okay. Now, what is the rationale behind this strategy? Let's try to understand this. First, the very simple way, how would you invest into cryptocurrency is buy it and hold on to it, right? This is what you can already do. What does the strategy say? Now, strategy is talking about two cryptocurrencies which are having both of them have a similar um, area of expertise. Monero coin is known for its privacy, and so is Dash. The coins use very cryptographic techniques to obscure details from transactions and provide the anonymity feature. So, see, there are a lot of cryptocurrencies which are very good at anonymity, but Monero and Dash are two of the best. Monero, above all of them, is best known privacy coin, and it has a market cap of $5 billion. Dash's market cap is almost half of the Monero. Monero is the market leader. Dash offers uses the facility for both anonymous as well as standard transaction. Monero uses ring signature coupled with stealth wallets. And again, technology wise, Monero is much more advanced, right? Now, Monero, if you see from the beginning of the year till now, as a cryptocurrency, it has gone up by 130%. Dash is way higher than Monero, around 200%. Now, Dash has outperformed Monero, okay, in terms of the gains because of several reasons. Their direct payment app is coming, which is focused on the retail market. And all when I'm talking about retail market in US, talking about companies like AutoZone, Chipotle, DoorDash, GameStop, Home Depot, and others, Subway even. Monero had come under the regulatory purview, and that's why Monero prices are down. So the only situation is that why we get into this trade, because we expect Monero to level up with Dash, right? So because both of them, the ratio of their prices, now comes the second leg of the strategy, the charts. See, currently the ratio, which means the product, the sum of or the prices when divided, that ratio is sitting at 0.8446 levels. Okay. How do I know this? Look at this. Look at this chart right here. Let me zoom this for you. Here. So currently the price is over here. Look at the mouse or the cursor which I'm moving over here, 0.84. Now we have seen, so this chart is the ratio chart. Okay, this is a historical movement in how the prices of Dash divided by the prices of Monero. What is the chart? How much that particular number has moved, that ratio has moved. Now it is here, and it is expected to, let's say, go to 1, at least here. I'm not talking about these levels. I'm not talking about these levels. Let's say even if you're expecting from this to go here to 1, right? Because we know every time it comes 0.6, it bounces back. Look here, bounces back, bounces back, bounces back, bounces back, bounces back, and now again it's here. So the whole idea is that this gap between Monero and Dash, consider this ratio as a gap, that this gap between Monero and Dash will increase. And how it will increase? If Dash prices go up, or if Dash prices, for example, so just 1 second here. Yeah, right here. Yeah, if Dash prices start going higher, Monero prices start going down. So the whole idea is we are looking to see the ratio at $1 level with the resistance seen at 1.5 and 120. And on the downside, the ratio support is seen at 0.6. So what happens is in a pair trading strategy, we buy one and we short sell another, and we expect prices again to level it and comes back with the ratio. And you can do this strategy on your platform itself. So for example, let me show you right here. So let's take Dash. This is right here. And I'll take Monero as well. So now guys, I'm telling you how to implement this strategy, okay? Let me close all my trades which I have, positions, and close right here. This is the Bitcoin short sell which I did. Let me close this. Yeah. Now equal amount. So if I buy Dash $50,000, okay, or let's take $20,000, and I short sell Monero $20,000, same value because it's a pair trade. So the amount, total amount needs to be the same for both the sides because I'm trying to create a market neutral strategy. See guys, both of the coins are cryptos. Okay. So when crypto market goes down, almost every coin comes down. But using this strategy, what we are trying to focus on is you are buy on one, you are short sell on another. So tomorrow, if there is a sudden surge or a decline in the market, you have money in both the legs. And both these cryptos are separate, but they have the same feature. So that's why we are taking two relatable products. Okay, and buying one and short selling another. So you buy Dash, short sell Monero, and the strategy is done. So when you go to your positions right here, you will see starts. Now the whole idea is that you have $20,000 worth buy Dash, $20,000 worth Monero sell. What you need to do as an individual, you have to track that when one of this position is in a profit which is higher than the loss in another. All you look for in a pair trade is a net profit. The one mistake which a lot of investors do, oh, 1 second, sorry. My display is right here. Okay, now I hope it just gets freezable. Okay, can everybody see this now? Yeah, let me do this transaction once again. I think the screen was frozen. 1 second, let me do this again for you. So what you do is you click close here. This is Dash, click the order ticket, open it. And then this is Monero. Again, open the order ticket. The strategy says you buy Dash. So let's say I'm going to put $20,000 in Dash and short sell Monero. How I'm short selling Monero? I'm borrowing it from the broker's inventory, expecting prices to come down. So either Monero will come down, Dash will go up. So this is Dash, buy and sell. Right? So I took both the trades. I go to positions. Now I'm expecting Dash will go higher, Monero will come down, and this gap between them, the ratio, it will go higher because this ratio, it was 0.8, it is expected to go to 1. So Dash price has to go up or Monero price has to go down to increase the ratio. So this is something what it is called, we call it as statistical arbitrage, pair trades, ratio trades. It is different from the normal speculation what you would do in a cryptocurrency. Okay, let's see this while we are talking about these things. Let's say yesterday. Okay, talk about one day and okay. Okay, so right here. Look at the price. Okay, from here, for example, the drop till here. Okay, 11.3%. Monero. This is Monero. Take again 1 day. What I'm showing you is the price movement, both of them. And this is Monero. So just look at this. Look at this. I hope I can capture the fall here. Look at this. So close. Somewhere if I would take it. See. Now, if I see it since yesterday's fall, okay, Dash went down by how much? Look at the chart. Well, I know for now you might be a bit confused in what I'm discussing, but let me show you what I mean graphically and ready to answer the questions just in case if you have any. Look at this. So Dash fell down by 11%. Okay. What is your strategy? Your strategy says you buy on Dash. Okay. And you're short sell on Monero, which means you want Dash to go higher, then you will make profit. And you short sell Monero because you want Monero to go down and then you will make profit, right? Because short selling, we make profit when prices go down. Now, yesterday when crypto fell, Dash went down by 11%. So if you had bought Dash, what would be your loss? Use your chat options, guys. Use your chat options. If yesterday you bought Dash and I'm telling you the Dash went down by 11%, what is your loss in the Dash position? Perfect. The answer start. Okay. 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 Right. Right. Perfect. So I think we agree that Dash if you bought the Dash cryptocurrency yesterday, and I'm telling you it went down by 11%, that means the loss which you faced in your Dash position, it is 11%, right? Now, let me show you Monero. Now, Monero, similar way, the same price movement which happened, it is down by how much? 19.5%. Now, tell me one thing. Did you made a profit on Monero or did you made a loss on Monero if you were using this strategy? If you bought Dash and Dash went down by 11% and you short sell Monero and Monero went down by 19%, do you have a net profit or net loss? And if it is a net profit, how much? If it is a net loss, how much? Use your chat options, guys. Use your chat options. You will figure this out. If you bought Dash and short sell Monero, Dash went down by 11%, Monero went down by 19%. Do you have a profit or loss? If profit, then how much? If loss, then how much? Try to answer this question for yourself, and you will feel so much elevated than you were before. Just to understand that how many ways we can trade strategies. Okay, great. See, anybody who is replying, you're a winner in itself. There is no right and wrong answers. If you're saying it wrong, maybe I'm not able to explain it properly. If you're saying it right, then you have grasped it quickly. That's all it is. But we can always give more time to this. This is not something. This is used by hedge funds, so I would not be expecting you to just understand it once in a while. But all of you are bang on target. So you're talking about 8% net profit, right? So even from yesterday's fall, when the entire crypto market lost money, had you bought only Dash, had you bought only Monero, you could have just lost money like everyone did. But if you had done the strategy where you bought Dash and short sell Monero, you would have seen a net profit. So now you understand what market neutral strategy actually means. Market neutral strategy is definitely not about you making this net profit of 8%. It is more about that if something like this happens and crypto markets fall, at least you have a market neutral way of dealing with it rather than just being a plain speculator and trader and saying, oh, my portfolio is down now, there is nothing I can do. Right? So this strategy is what it was. And what was the basis of this strategy, guys? Once again, how did we land to this particular strategy? And what we talked about was the ratio. So this is where this is important. As I'm just zooming in this one. Let me see here. See, this was the basis, this chart, which is the ratio of the prices of Dash and Monero, which seems to be climbing higher and finding support when the ratio is zero 0.6 and it was 0.8. So ratio was 0.8. We expected ratio to increase, which means the price of the numerator will go up, denominator should go down for the ratio to go higher. So since the Dash is the higher numerator, Monero is the smaller denominator, you buy Dash, short sell Monero and expect this to come down, this to go up. In the market when cryptos were falling, Dash went down, right? Dash went down, but Monero went down too much. So the ratio still increased. So that's the point why we call it as a market neutral strategy. And this is the reason why we call it market neutral strategy. I'm sure you'll have a lot of questions. So just keep writing. And again, guys, I'm available for a one-on-one session to understand more on these strategies. So please do not worry if you don't understand it today. We can always have a one-on-one session with a consultant and we can definitely explain you more. Okay, now coming back, there's a different kind of, so we talked about market neutral, we talked about pair trading, and there are a lot of pairs in the market. So let me tell you one of those. Let's see this one. So remember the example of the crypto period which I did. And now let me show you something like this. Okay. Now talking about sugar raw and sugar white. So yes, there are two kinds of sugar in the commodities market. Okay. And both these kind of sugar are traded a lot. Is it right here? Yeah. Now, when we talk about sugar raw, it is a US based sugar. And we talk about sugar white. Please use your notepads if you want. Write it down. I mean, anyways, you will get these strategies if you talk to your RMs, but write it down. It's good for your understanding. Sugar raw is a US based sugar. Sugar white is a London based sugar based on Brazilian one. Sugar raw prices, which is US. So I'm going to name it US and UK. So it is easier. Okay. US sugar is more correlated. Correlated means if the price of this goes up, the price of this also goes up. If this goes down, and this, they are correlated with each other. So sugar raw prices are much more correlated with US gasoline and oil prices. Okay. Sugar prices in US are much more correlated with US gasoline and US oil prices as compared to UK sugar. Now, there is a reason behind it. The Brazilian government, they enforced a minimum 27% ethanol blend with the gasoline. And in US, there is no such requirement. Now, US gasoline prices, they rise when the demand for US sugar goes up because US sugar, the sugar cane is used for producing ethanol, which is the alternative for gasoline. Now, US sugar prices, they are not highly impacted as the minimum criteria remains fixed at 27%. Sorry, UK sugar prices, sugar white, the movement does not impact the UK sugar more because there is a 27% criteria that remains fixed even if the gasoline prices they fall. But US sugar is very much connected. So what happens? Majority of the US population demand for gasoline and oil is expected to remain elevated at least until the winter season in US, that is the end of November and start of December. Now what the strategy says, see, look at the percentage returns, nothing else, just look at this. Okay, just see what I show you at once. Look at the first bar, first column from 2011 to 2020. Okay, look at the UK sugar, which is sugar. So sugar raw, US sugar, sugar white, UK sugar. Look at sugar raw, the percentage returns every year, and look at white sugar percentage returns every year. Just look at it. Okay. Now tell me which has outperformed what, just by looking at the first column here, right? Which has outperformed which instrument for the maximum number of time? Can write your chat in your chat options. When you see this number from 2011, so if I ask you a question from 2011 to 2020, between the percentage returns of sugar raw and sugar white, which one outperformed the other? So if you think sugar raw outperformed, write sugar raw. If you think sugar white outperformed, write sugar white. So what you will see is, absolutely, I like how everybody is enjoying this actually. So I know, because normally you would not hear about sugar as a tradable commodity, right? Like every session is about mostly about either cryptos or stocks or dividends, but this is something really amazing. So if you see it from 2011 to 2020, every year sugar raw has almost outperformed, except 2011, it was minus 20, minus 20. So it was both the sugars lost a similar percentage. But 2012, if you see, raw outperformed. 2013, raw outperformed. 2014, outperformed. Because if sugar white is down by -4% and raw is up by 1%, still outperformed. 2016, net zero. 2017 outperformed. 2018 outperformed. 19 outperformed. 20 outperformed. So basically, the idea is that most of the time sugar raw has outperformed in last 10 years to sugar white. Now, next column which you see is that if you buy sugar raw, now go to the second column. If you buy sugar raw and short sell sugar white, buy sugar raw and short sell sugar white, you will have positive returns. You would have positive returns almost every year except 2016. Right? Now, so all I'm trying to tell you is that many a times when we do these pair trades, it kind of gives us an edge, because if you only did a trade in sugar raw or only did a trade in sugar white, you could be on the other side of the market. But when you take a pair trade, when you take a market neutral trade, now over here, again, this is just the performance. Now, when we see the rationale behind it here, look at this. So a lot of backtesting for these strategies done through by a lot of computation on numbers. Between the period of September to November, sugar raw has outperformed sugar white in 9 out of last 10 years. Please note this down if you have a notepad with you. Period of September to November, sugar raw has outperformed sugar white in 9 out of last 10 years. While the reverse is true between the period of March and May, where sugar white is seen outperforming sugar raw. So if you break it down from yearly to months, we have done month-wise research also. And what we understood is that in last 10 years, out of 9 times, sugar raw outperformed sugar white during November. Basically September to November, right? And sugar white outperformed sugar raw during March to May, right? And that is connected directly where we see that the demand for gasoline and crude oil is expected to remain higher at least until the winter season. And sugar raw is more correlated to US gasoline, right? So because sugar raw is more connected to US gasoline and gasoline oil price is expected to be higher in winters, which is November to December, and we have seen sugar raw outperforms 9 out of 10 years to sugar white during November, September to November. By connecting the dots, you reach to a point where you feel that it is good to buy sugar raw, short sell sugar white during these times, since 2 to 3 factors put into place. And this is their ratio chart, which you can clearly see that the ratio, look at this chart. I hope this is self-explanatory over here, that every time this ratio, this was a big trend which was going on, and now this trend has, this resistance has been broken and the ratio is continues to go high. So basically, once this whole resistance from 2017 to 2021, this resistance is now broken and the ratio is on the higher side. So again, guys, this is one of those traits which you see and which you start understanding from a different perspective. Not talking about speculation here, I'm talking about mostly which is what we call as, again, market neutral. These are strategies which form a part of statistical arbitrage, because there is a lot of comparison done with the ratios. And then after back testing these strategies for years and years, we come up with a point that, okay, this is something which we should do. Is there a risk? There it is. What if the ratio, instead of going up, comes down? Then your trade is reverses, right? So there is a time where there is a drawdown also. So your consultants, they talk to you and they give you a maximum drawdown, that what can go wrong with this strategy. So that's why I said that I'm going to discuss a lot of things with you, but you don't have to go home straight, start your live portfolio and take these strategies. You have to see the negatives behind it. You have to see what can go wrong in last few years, how it has gone, and talk to your consultants before you switch to it, right? Now, this is about pair trades, and there are a lot of pairs which we can work with. Let me tell you something which is related to seasonality patterns. Now, how seasonality works, this is another strategy. It's not market neutral, right? But market neutral comes ratio trades, pair trades, statistical arbitrage. Another line of strategy is called seasonality pattern. How seasonality works? Something called, so again, I'm taking sugar raw here for the seasonality as well, because now you can relate it with the example. And this was created on 31st August. So these are recent strategies, what I'm talking about. Uh, Below is the heat map for sugar raw. Hope everybody can see this. Okay, great. Now, look at this. When you see this here, although the chart is explanatory here, see, um, here. So I'm just going to give you 5 seconds to look into this chart. You can click a picture if you want, and then I'll scroll up and we'll start reading this, right? So what you're seeing right now, let me show you what you're seeing. You're seeing sugar raw monthly returns in last few years from 2006 to 2021, last 15 years, how sugar raw has month on month wise, how much, whether it has ended the month positive or negative, every year in last 15 years, every month. Now, if you see in the image, month of September has been positive for the commodity in 12 out of last 15 years. So look at September and look at June also. Look at June. June, again, in last 15 years, 17 and 18 has been negative for June, but otherwise mostly positive. And look at September. Again, 1, 2, 3 times negative, most of the times, again, positive. But if you see others, there is no such pattern, right? So we are looking at a seasonality pattern where June and September, these 2 months, we look at. I mean, currently we are looking at September because this is the month of September. We cannot go to June and do the trade, but right now it's September, so we are comparing that. September has been positive for the commodity 12 out of 15 years. Commodity has provided an average return of 6.2% in the month of September, with the maximum return being 20% in September and maximum loss being 14% in September. So it's very important information, right? If I look at September and I see that, okay, maximum red, which I saw, I hope everybody can see this. Let me zoom this in. So, okay. Now tell me, when you're looking at the September month, tell me the maximum loss sugar prices have seen in September. Please use the chat options. If you can't see the number, just tell me you can't see the number, because I've tried to zoom in more and more to fit this into the window. Tell me the maximum negative sugar raw has seen in last 15 years in the month of September. Go ahead, guys. Okay. Maximum, okay. Okay, maybe, okay, maximum negative. So that's 3 times. Okay, can you also tell me the number? What is the percentage maximum negative return? Sorry, I was not clear about it. So it has gone down 3 times. But what is the maximum negative percentage? If I say that sugar raw has fallen this much percentage the most in last 15 years, what is that number I'm talking about? Go ahead, guys. Go ahead. Okay. I know most of you must be very frustrated by me telling you to always use the chat option right over it, but that's the only way webinars can be useful for you. Otherwise, you'll never be able to take the message from it. Okay, those who said 14, right? Those who said 15, right? Those who said came down 3 times, yes. So all I'm trying to tell you is, in the month of September, in last 15 years, only 3 times it has happened that sugar raw has shown negative returns. And out of that, the maximum negative which they have seen is 14%. So here it is. If you use this strategy, somebody said 24%. Maybe you're seeing it somewhere else. In September, it's not 24%. So just see in September itself, you will find it. So what we see is that in September, if I have to think that, okay, let me buy sugar raw, uh, because mostly in September it goes up, it has shown positive returns. But then the other side of yours, which is the risk concern side, if ask yourself a question that, okay, Yogesh, that's all right. But what happens if it doesn't show me the positive return, if it shows me the negative return? Where should I book my loss? Now here it is. You know that in last 15 years, the worst which you have seen in last 15 years is 14.7%. So be ready to take that loss, 14.7%. If it starts going beyond than that, close your trade because we don't know, it may be a new low. But at the same time, if we are talking about maximum high, what could be the maximum high? Somewhere around 20.49%. So if you see the September month in the similar way of how you see negative, you can see positive be around 20%. So today in the month of September, if you buy sugar, on an average, you would expect a return of 6%. If it goes down, maximum loss, you would expect 14%. If maximum gain, you would expect around 20%. This is called a seasonality pattern strategy, guys. This is again something which is bigger than speculation, right? You're not talking about speculation. Now, let me tell you some fundamental factors behind it. So, seasonality strategies are based again on the basis of heat maps and numbers. But let's add to some fundamental factors. Global sugar supply crunch has been talking point a middle of drought-like conditions in Brazil versus increasing ethanol demand. Last year, 2021 season, Brazil exported 32 million metric tons of sugar, around half of global exports. For the current season, USDA sees those exports dropping by approximately 3 million tons due to the frost that caused the worst drought in 91 years in the first half of 2021 that has damaged the sugarcane crop output. In addition to demand for sugar, demand for ethanol, which is a byproduct of sugar, also leads to a price rally for the sweet ingredient. South American nation is seeing record prices for ethanol as COVID-19 restrictions ease, thereby increasing consumptions of the biofuel. That means mills could start processing more sugarcane into ethanol rather than into sweetener. So to add to this, increase in ethanol blending in India should also drive the sugar prices higher. So there are strong fundamentals behind increase in sugar prices. And then we are in a month where sugar raw normally gives positive returns as compared to the previous months. So all in all, it makes it a good seasonality pattern to work with, right? So I hope the seasonality pattern is clear to you because this is another. So we understood statistical arbitrage, which is a pair trade between Monero and Dash, between sugar raw and sugar white, which is based on the ratio. And then we understood something different, which is seasonality pattern, which is based on a heat map on last 15 years backtesting that how every month the commodity has performed just to see that which is the most bad or most best month. If it's the most worst month, right? If it's one of the worst months, like March, for example, if it was any more red, I could have told you that, okay, why don't you short sell sugar raw in March? Because it is expected to go down. You can make money if the price comes down by short selling it, right? So there are both ways a seasonality works, right? I'm going to show you a similar example last month. I'm sure there were people who attended my session last month when we were talking about natural gas seasonality. Now, this was natural gas seasonality, right? And for 10 years, same thing. We saw 3 out of 10 times natural gas has gone negative in August, but mostly positive. Now, if you compare, if you had bought natural gas in the beginning of the August, by the end of the August, your portfolio would be 15% higher because this seasonality pattern worked, right? You can compare the returns as per yourself, but this is what the numbers are. So this is again something, guys, which you can always try in your portfolios. So if I were to devise my portfolio, one big portfolio where I would always be keen to long-term invest, which is every investor has it in mind that I'm going to park some money in these shares and not going to look at it. You do that, but when you do that, there will be two kinds of stocks. One will be growth stocks like Teslas and Amazons and Facebooks, which have the potential to grow further. And then there will be some value stocks which give you a fixed dividend also. So there are stocks like Coca-Cola, ExxonMobil, AT&T, for example, which gives you good dividend, fixed dividend every year. So you invest in both of those to divide your portfolio. So those are your long-term stocks. Then there is a stocks portfolio of those companies which are small now, expected to be very big. Companies like Fate Therapeutics, which probably are in a growing stage, right? So you can put some of those. Again, that will be higher risk as compared to the ones which you did right now. And then there is a separate leg for strategies. Somewhere you can do seasonality patterns, pair trades, after you carefully understand that what are your profits and losses in this. So rather than speculation, which should be the least point in your portfolio, strategies overcome speculation, because speculation you are just doing naked trades, right? And with strategies you have one leg buy, one leg sell, and trying to make sense out of it, so that becomes market neutral. And then there are seasonality based strategies which comes with solid statistics behind it. Now I'm sure you will ask me, what if statistics fails? What if everything fails, right? We have to have a hook, we have to have a base on something our strategy should rely. And historical pricing and statistics, this is what it is. This is the era of artificial intelligence and computation. There are high frequency trading platforms which are putting algorithms in the platforms which are being traded on the basis of technical. So historical pricing, data is gold. So these days, anybody who is able to make the best use of data wins it all. And this is something which is applied in the financial services as well, right? So this is something which I'm here to tell you. So we did sugar pair, we did sugar raw. Now there is one more strategy. Actually, there are one more strategy which I'm trying to open it here. Let me see if I can do that. Uh, okay, here it downloads. Just download it here. Okay, let's check this. Okay, share my screen here and try. Okay, I'm just going to share the windows like that. And sorry for this inception type outlook. Look at this. Okay, now let me see if I go back to my screen. How does it look? Okay, still looks the same. Okay, I'm just going to explain you this strategy here and make sure that doesn't. Okay, so I'll answer your questions as well. Let me share this strategy. I hope everybody can see the gasoline and WTI oil pair. Okay, so there is a strategy between gasoline and WTI crude oil pair trade. So we just saw the correlation between sugar raw and gasoline. Now gasoline and WTI are also very highly correlated. Their last 6-month correlation are 88%. If you see the 5-year correlation between gasoline and WTI, it's almost 90%. Now the important thing is, month on month, gasoline has outperformed oil between the period of September to December. So once again, we are going with the statistics, right? Last time we saw that how sugar raw outperforms between September to November to sugar white. And similarly, now we have seen that gasoline has outperformed WTI between September to December, around 8 out of 10 years. Now, one thing, so that brings us to a point where you buy gasoline and you short sell WTI between September to December, expecting gasoline to go up, WTI to come down, and that also serves the basis of look at the 5-year ratio chart, which is almost bouncing back from the uptrend line, right? So over here, the strategy is very simple. You buy gasoline, you short sell WTI, expecting gasoline prices to go up and oil prices, crude oil prices to go down, because month on month performance, if you see September to December, 8 out of 10 times gasoline has outperformed WTI, which means crude produced better returns. Now, something like this, when comes across, makes a lot of sense because, again, it's one of those strategies which we are talking about, right? I'm not showing the. Okay. Yeah, I think this is actually a operational issue. 1 second. Let me see if I can share the same thing with you. Just give me 1 second. Okay, meanwhile, there's a question. If the price drop on a seasonality sugar trade in September, can I mitigate the loss by keeping the lot until the price picks up again? You can. See, if you want to hold on to the trade, so it's a good question, guys. Somebody asked the question that if the price drops on a seasonality sugar trade in September, can I mitigate the loss by keeping the lot until the price picks up? Now, it is your choice that if you don't want to book the loss, if it exceeds more than 14%, if you don't want to book the loss, then don't. Want to hold on to it, hold on to it. But then holding on to a commodity has its own consequences, right? Sometimes when you buy it and if the price comes down, it might take time for the commodity to pick up. It's a common bias that something goes down, you don't want to book the loss, so you want to hold on to it. I would strongly suggest that if it exceeds your risk threshold, then just close your trade and wait for another. That's it. Okay. Meanwhile, let me see if I can share this file. Okay, this is pair trade. Let's see if I can upload this here. Right. Okay. 1 second, it's been uploaded. Share. Okay, I just shared a flyer with you. Can everyone see this? Did you get the flyer? It says that it is being shared. If it is shared, give me a yes or a okay. If you have downloaded in your system or if you can see this. It should come as a file on your chat. Just see if it is there. Okay, perfect. Everybody has it, right? So if you can see this. Now so if you open that flyer in your systems, now let me take it this way. So when you open the flyer in your system, I'm going to show you. So you start the flyer similarly. Now what you can see is the first heading, gasoline WTI oil pair trade, okay? Before you do anything else, just look at the first column where it says September to December performance in last 10 years. If you had bought gasoline and short sell WTI, 2011, your returns would be negative. But in 2012, positive, 2013 positive, 2014 positive, 2015 positive, 2016 positive, 17 negative, 18 positive, 19 positive, 20 positive. So 8 out of 10 times, if you bought gasoline and short sell WTI, you would end up making a net profit, right? Average return 4.1%. The hit ratio of the strategy is around 80%. Now, the pair trade is also based, if you come down and see the ratio chart, like we have seen, look at the bottommost chart, which shows a trend line, which is slightly slanted. And you can see that this is the trend of the ratio, which is going upward. And it is just on that line and it is expected to bounce back, right? So the whole idea of this is that the ratio is also expected to go higher. So you buy gasoline and you short sell WTI expecting the ratio to increase. This is what the strategy is about. And there is an added holding cost factor also in this. Now, this is where the interest part comes in. How the interest part comes into this picture? This is where we see that when you short sell a commodity and when you buy a commodity, there is something called a carrying cost or a holding cost, which is there on commodities. If sometimes you receive that, sometimes you pay it. So when you are buying a commodity, you will pay a certain holding cost. But when you short selling, you receive something. And sometimes what you receive is way higher than what you pay. So there is a net rate of 35 to 40% in 1 month, which you receive as an interest when you buy and short sell these commodities. Of course, holding cost or this interest or the carrying cost, which I'm talking about, it is subjected to changes every month. So every month on month, it will be a different number. But but this is more like a bonus thing. What you need to focus on is on the ratio. Your risk and reward is based mostly a lot more on the changing carrying cost and also on uh, the ratio between gasoline and WTI, right? So this is one of those strategies. Now, let me, before you guys leave, let me tell you something about the uh, China markets, because a lot of you asked last time if we want to enter into Chinese market, how we do it. I'm not sure how many of you are aware of options, but this is something which we can do. Okay, look at this. I hope everybody has this flyer with them. See, it's a good strategy, but I'm sure a lot of you must have not done options before. Option is also a derivative where you pay a certain amount of premium and you get the choice to exercise that option or not. So, for example, um, if you buy a call option of say Facebook at 300 and the price is say for example 250, tomorrow if the price goes down to 200, you can exercise that option and sell your Facebook shares at 300, right? This is something what an option is, and you to buy that option you pay a premium over it like an insurance, uh, and that is how it's done. Now to enter into the Chinese market, of course I'm available for a more discussion on options, but just to show you the strategy, how you enter into the Chinese market right now. As many of you know that Chinese markets have been down due to the increased tech regulation, and all the key stocks, look at the companies like Alibaba, Baidu, and JD.com, which have super Bloomberg analyst recommendations also. And their earnings, if you see, have also grown over a period of time. And these are big companies, they have niche in their own product. Those stocks are down just because of the regulations. So if you feel that this is a falling knife, is it worth catching it? So, first question you have to ask yourself, do I want myself to be exposed to the Chinese market? Once you are ready to take that risk, then comes your next part, that how should I enter? Should I just buy Alibaba stocks and see where it goes? Or if there is a better way of reducing my risk? The answer is there is a better way of reducing your risk, because what happens using an option based strategy, what you do is you enter into these companies, but there is a certain amount of structures to it. Now, again, guys, I'm more happy to discuss it with you one on one, because there are a lot of numbers over here. All I'm saying is, uh, you sell a put option. When you buy an option, you pay a premium, but when you sell an option, you receive a premium. So in this particular option, you will see that you will be selling a put option, you will be buying a call option, and when you do that, you will see the comparison between, look at this. So if you had just bought and hold Alibaba shares at the current price, which is 170, okay, right here, right here. So if you had just bought and hold Alibaba shares at 170 and it comes down to $50 scenario, one lot is 100 shares. So from 170, it comes down to 50, which means down by $120. Your loss is $12,000, right? Simple calculation. But by using this option based strategy, your loss is reduced to 8,900. Why? Because you sell a put option and you buy a call option. You not only you receive a smaller premium over it, but also your loss is capped. So look at this diagram over here. I hope if it is understanding. When you buy and hold, which is in blue. So when you buy and hold Alibaba, when I say buy and hold, which means you're taking a naked position, that you're buying one leg and keeping it open. If it goes down, it goes down. If it goes up, it goes up. That's the blue line, that it's straight, right? If the price goes below 170, your loss starts. If it is above 170, your profit starts. But the orange line is your option, where if you sell a put option and if you buy a call option, there is a certain cap which protects you at least $30 down the line, and your loss starts later than that. That's the point of having options. So I'm just going to make it very simple for you. Of course, there is a lot more to understand into this, but I'm going to make it simple for you. Look at this orange line. It is not perfectly diagonal like the blue. It gives you a straight stability for a certain amount of cap. That is where the options are put and the structure is created. So this is how normally, again, guys, it's a derivative based strategy. So it works for the options. And like this, you can use this in other instruments as well. There are few things that these are exchange based strategies and on exchange based platforms. So minimum lots are 100 lots. Leverage is not that much. So you have to put a certain amount if you want to do these strategies. But again, doing this strategy would look at this. Your average loss is reduced by 16% if you just buy and hold, and if you use the options. By using the options, your loss is reduced to 16% in case if the price starts falling down because of that particular cap which is there in the structure. So like this, there are a lot of such strategies. And one last one before you leave is, since Expo is coming in the spirits of that, we have talked a lot about expos. Top partners, their stocks, and some fun facts. So what we are going to have is Dubai Expo, much talked about. 182 days of event, and 200 plus 190 participants, countries, 25 million visitors, solar panels, 3 district pavilions, sustainability opportunity, mobility opportunity. One thing which we need to understand here is there are companies which are official partners. Swatch, which is the official timing partner. Official Expo 2020 watch is by Swatch. Ibitcar stands for innovation and features. That Expo 2020 Dubai logo that takes its inspiration from a ring found at a 4,000-year-old archaeological site in the desert. Accenture, and this is their price chart, guys. So Accenture led the design strategy for innovative, powerful, personalized, and engaging digital experience that will bring Expo 2020 to life for millions of visitors. Then there is Pepsi, which is the official beverage and snack partner, and this is their price chart as of now. Company will show millions of people what sustainable and innovative food and beverage practices looks like, and inspire and educate millions on water stewardship, sustainable packaging, agriculture, and nutrition. Then there is Mastercard, which is official payment technology partner, and this is the chart looks like. Companies expected to showcase technology that includes virtual reality, face and fingerprint recognition, as well as voice shopping, right? And then there is SAP, which will support the delivery of personalized experience, and this is the chart for it. So if you see, these are few companies which will be there in Expo 2020. Somehow they are connected. Their total revenues, number of employees, and their Bloomberg analyst recommendations as well, right? So this is something which, again, we can talk further about what kinds of strategies we can always look at. And guys, today's session was not just about understanding where to invest, it's about how to invest. We all know that we can always speculate. There is always a room for somebody to tell you that, oh, this is the support, this is the resistance, buy now, sell now, put a stop loss. It's there. But in times like today, it is not enough. It's just not enough to have something like this. You need to have a separate leg, which is there in the form of strategies, and you can use it very well. So that is something which, again, I wanted to talk about today. I'm sure all these flyers, if you talk to your relationship managers, it will reach you, and you can always talk to me, have a one-on-one session, and I'll be happy to discuss these things in much broader perspective and from a risk and reward point of view. On behalf of my team of Century Financial, my family, I would definitely want to extend a big vote of thanks to anyone who's into the healthcare or medical facility, doctors, first responders, midwives, anyone, nurses who are working hard day in, day and night to keep us safe. If you know anyone, if it's in your family, or if it is you as an individual, a big word of thanks on behalf of my family, myself, my company, and everyone in my company, actually, and continue the good work. Thank you so much for that. We'll meet next week with a different topic, with a different session. If you like this session, please review us on Google. I like to do these sessions again and again, and these are free of cost sessions. We discuss a lot of strategies. So I would really appreciate if you like this session, go on Google, review Century Financial Consultancy, give us your feedback if you want us to improve on it, and we'll definitely will come up with different topics. Right. So once again, thank you so much. Unless if you have any other questions, or there is one more question, please your personal opinion about what will happen to Bitcoin now, and will it worth to buy now and hold by the end of the year to see the increase? So it's funny because today a Bitcoin outlook came by either it was JP Morgan or some company would say that it's going to be between 50,000 to 175,000. See, one thing is there that digital payments are increasing a lot. El Salvador has become the first country to give assign Bitcoin as a legal tender. So I normally, as an investor, if it was my individual opinion, my personal opinion, I see crypto prices actually moving forward because there is a lot of institutional participation. That being said, I will be more focused on. I'm so glad you asked this question because I'll be more focused on investing into more sustainable, more what should I say, sustainable, more environment friendly cryptos like Cardano. It's more environment friendly. Mining of such cryptos is important because sooner or later, the climate change is a big issue. And sooner or later, mining of Bitcoins, which are not sustainable, or mining of cryptocurrency, which are not sustainable, is going to be a question. So I would always feel that Cardano is something which we can always look into. It's more sustainable. It has its volatility, but the only point is cryptos are volatile. So we have to agree with that, that it's going to be up and down. But if I were to choose, I would go for Moneros and Dashes and something which is lower value, which is on a development stage. Bitcoin, again, the risk is high. So if you are willing to take that kind of chance, that is there. One thing which you can also do is something which we have here on the platform called a crypto index right here. Apart from doing the strategies, see, there is a crypto index, like emerging crypto index. Cryptos. See, all crypto index and emerging crypto index. Emerging crypto index doesn't have Bitcoin. It is an index which tracks the performance of the Cardanos and the Moneros and those cryptos which are emerging right now. So you can always invest into these kind of indices also, just to reduce down the volatility factor which is there in cryptocurrencies, right? So that can actually help you out a lot. Other than that, please, I'm more than happy. If you have any other questions, I can have a one-on-one session and just talk to your relationship managers, and I'll be more than happy to sit with you. Come to my office. We are ensuring all the health and safety standards are fulfilled. Everybody is wearing masks around. I'm in the enclosed cabin right now, so I'm not wearing one, but then we are making sure that the place is fully sanitized. So if you want to come and pay a visit, sit down, understand, talk to your consultant, definitely we are able to do that. So this is a value addition which Century provides from our side on the basis of consultancy and strategies, right? So once again, big word of thanks. We have covered a lot of strategies today, and I hope that talk to your RMs, take demo accounts, try to do these strategies on your own and see what's the impact. And for there is one question about live accounts. Don't worry about the live accounts. It takes 2 days to open it. Just see what you want, and we are doing commodities, currencies, indices, everything. So if you need a demo account, talk to your RM. For live account, you just have to submit your passport copy and visa page and address proof. Fill the form online, and it will be done. So RM can, a relationship manager can actually help you with that. So that is all the questions being answered. Anything else if you have in mind, please call me. This is my email address. I'm just putting it out right here. Yogesh@century.ae, and I posted it here. So if you have any queries, you're not able to reach anyone, reach me out. More than happy to reply you. Right. Thank you so much, guys, for sticking with me for an hour or so. And I really appreciate your concentration, your answers, your chats. I will be back next week with a different topic. My name is Yogesh. Have a good night, be safe, and be invested.